Good morning, everybody. This is Trevor Garvin from Ned Group Investments here, and welcome to the Ned Group Multi-Manager first webinar. It's very exciting to be presenting to you today, along with all our other presenters. And really, this is the first of our Multi-Manager Insights webinars, and our aim is to bring you these types of webinars 3 or 4 times a year, each time lasting for between 1.5 to 2 hours. And we would like to bring you a range of fund managers that we have relationships with across our funds, whether they be in our domestic fund range or our offshore fund range, that we think will be able to give you some interesting views, some thought leadership, inspiring stories, and much more. So what the idea is with these webinars as well is it's not about a product push or anything. It's purely about providing some insights, thought leadership, guidance to you guys, our clients, our investors, wealth managers, financial advisors, in order to help you with your clients and with your businesses. Just very briefly, in terms of Ned Group Multi-Manager, we're a team of 9 people. We're located in Cape Town, in London. We manage around about 30 billion rand, range African rand denominated, and US dollar and sterling Irish domiciled fund of. We've been managing multi-managed funds for 60 years and have quite a long investment track record. So in terms of today's, we hope to give you some comments and insights covering, first of all, domestic equities, domestic fixed income, as well as global equities, and then from Coronation, their house view in terms of valuations across all the various asset classes. And we're going to end off the morning with a presentation from Danny Diliberto from Ladles of Love, which is an inspiring story of how an NGO has been called to action during the COVID crisis. So our first speaker that I'm going to hand over to this morning is Rashad. Rashad Tayyop is portfolio manager at ABAX and is the manager of the Ned Group Flexible Income Fund. Rashad joined ABAX in 2012. He's got over 16 years investment experience. In terms of this fund, the Flexible Income Fund, we as the multi-manager hold it across a number of our portfolios in the enhanced cash part of our portfolios. We've held it for over 10 years within the portfolio, and it's been a consistently good performer. It's achieved 8.1% per annum for the last 10 years relative to the benchmark of 6.5%. So we're very happy with it, and we just thought it would be interesting for Rashad to give us his views in terms of currently the enhanced cash fixed income space. So I'll hand over to you, Rashad.
Thanks, Trevor. Good morning, everyone. It's nice to be able to chat to everyone from the comfort of my home in what's a very interesting time. I think, if you look at it from a South African perspective, the positive we can take from this is that we've been used to living with these type of uncertainties and volatility for a very long period of time. So if you look at the issues that the world is facing in terms of political instability, health crises, high unemployment, racial tension, budget concerns, I mean, we've been dealing with this for the last 2 decades. So maybe we're a little bit better in terms of an investment philosophical type of view to confront the issues that now the entire world is facing. So my job today is to talk about the outlook for fixed income. And I'll start off, if we move to the first slide, to just highlight the fact that for developed markets, there actually is no income. So it's really just the fixed component which is relevant for them. So if you look at that slide, what I've got here is the 2-year yield. It's effectively the risk-free government bond yield for two of the major economies in the Western world. It's the United States and Germany. The blue line, you can see Germany went to 0 yields in around 2011. They stayed there for a few years. And then by 2014, they went to negative yields. So the risk-free rate actually went negative in Germany as far back as around 6 years ago. They have not had any income for a very long time. The US obviously is the global reserve currency, the dollar is the reserve currency. They attempted to escape the debt trap that's engulfed Europe, that Japan has been in for the last 3 decades, and they tried to normalize rates. They made it 200 basis points. They unwound the balance sheet by about 300 billion, but unfortunately that effectively stalled the economy, tanked the market, and at the beginning of 2019 they had to reverse course. So they started cutting rates well before the COVID crisis, and income began to disappear in the developed world at least a year ago. So I mean, Powell, I think he made a valiant attempt, but I think the combination of what was happening in terms of negative rates all around the world, pressure from the President Trump wanting lower rates, I think it was just too much, and eventually the US capitulated, and now they're back at 0, and it's forecast to remain at 0 for a prolonged period of time. So for the developed world, there's no such thing as income. You have to take risk in order to get some sort of income. And if we move to the next slide, the reason for that is because of the excessive debt levels throughout the world. So this just shows you the breakdown of global debt from the International Institute of Finance, the BIS, IMF. You can see that between for the decade leading up to the financial crisis in 2009, you saw a massive increase in debt levels across the world. Leading up to the financial crisis, that was driven by households as well as the financial institutions. And then post-financial crisis, you saw governments as well as non-financial corporations increase their levels of debt. So we're in the unfortunate situation post-2009 that the world needed lower rates to stem a financial crisis. But unfortunately, the cure of lower rates has the effect of just encouraging more risk-taking and an increase in debt buildup. And what we've seen, it's been very pronounced in the last 5 years that corporates have increased their leverage massively. And I mean, that's by design. You lower the cost of debt, you effectively telling people that money is cheap and they must borrow more of it. So unfortunately, we're in the situation where we are forced to keep rates low because any attempt to increase rates given this level of debt will just cause the economy to basically turn downwards, and we risk some sort of depression. So it's going to be a very difficult and volatile period going forward. If we move to the next slide, you can see that South Africa is in the somewhat fortunate position that there is some yield left in the South African market. What I've got here is the South African, the repo rate, which is set by the SARB in blue, and you can see they've cut rates dramatically. If we thought, a year ago that we'd be leading into a debt crisis and they'd managed to take rates down to a record low of 375, we'd think you were crazy, but effectively the global situation has enabled them to cut rates extremely aggressively. The white line, so we're down to about 375 on the short end, which means that in a money market type floating rate environment, we can deliver you about 5.5. Now, that's definitely not great from a historical perspective, but relative to what's happening in the rest of the world, at least it's something. And if you do want some yield, I've got the white line here, which is the 10-year SA government bond yield, and you can see this for the last decade. It blew up, in the crisis, but it's back at around the 9% level. Now, if you think in the context of a 4% inflation, that optically looks like a pretty decent return where you've got 9%, a 5% real yield. So a lot of people would make the case that you need SAGBs in SA government bonds, get your 9%. In this type of environment, it's very enticing. But if you look at the next slide, you'll see that this 9% yield comes with an unprecedented level of risk. So in terms of solvency risk, South Africa, the risk has never been higher. We went into this COVID crisis in a very bad position in terms of our debt levels. You can see here the National Treasury numbers from the history over the last few years, the 2017, 2018, 2019 budget. We've been increasing for the last 10 years from we came from a level of debt to GDP from the mid-20s, around a 25% debt to GDP in 2007, which was it was a great position to be in. And we've allowed that debt to just increase dramatically over the last decade. So firstly, the recovery from the financial crisis, but also, 8 or 9 years of President Zuma, there was very little control over the government finances, and that debt just continued to escalate. And if you think back to February, when Minister Mboweni delivered the budget, it was just over 3 months ago, but in COVID time, it feels like a decade, the 2018 budget from February, we were delivering a budget of deficit of 7% for this year and next year, and our debt trajectory was getting up to 70% debt to GDP ratio over a 3-year horizon. And we were very concerned about that type of debt trajectory at the time, because for an emerging market to be at a 70% debt to GDP ratio, it's a very precarious position to be in from a solvency perspective. Now, that seems quite quaint given what's hit us as well as the rest of the world, because now we're going to be running a more than 10% budget deficit while GDP is actually falling. So we are now heading to over the next 3.5 years out to 2024, we are likely heading to 100% debt to GDP ratio, which if you then add in the SOEs, which is another 20%, 120% debt to GDP ratio over a medium-term horizon. That is a precarious position to be in. And I think that while we were teetering close to the edge of a debt trap, my view is that we are now firmly within a debt trap. And the only comforting factor is that the rest of the world is joined us in that type of scenario. So what are the scenarios for that type of situation? Effectively, a debt trap means you cannot escape it, you cannot grow unless you cut the level of debt. How do you do that? There's only two options. Firstly, you can try and restructure and haircut the debt to reduce that debt burden, or you can attempt to run a higher level of inflation in order to reduce the real value of debt over a period of time. Now, historically, that has been the path of least resistance, and that's the path that politicians generally go for because it's less painful, it entails less dramatic decisions. So unfortunately, I think once this initial crisis, if you move to the next slide, and the outlook for inflation in the shorter term, you can see that inflation has remained somewhat under control over the last few years, between 4 and 5%. And the analysis that we've done shows that inflation is likely to dip quite severely in the near term, close to the 2% level. Partly that's due to a lack of demand, but that's also partly due to technical factors where it's very difficult to measure inflation when you're in a lockdown type scenario. So what happens is you measure a portion of the basket, 60, 65, 2/3 of the basket you can measure, and then you have to scale that up to 100%. And that means that things like the petrol price, which has fallen quite dramatically, as was maybe 5% of the basket, it's going to become 8% of the basket, and it's going to have a very dramatic effect. So the things that you are going to be able to measure are going to be dramatically upweighted, and you're going to cause this significant near-term dip in inflation. But once those technical factors come through, and once the economics of the situation and the realization that we have to cut this debt, once that begins to come through, you're going to see the South African government as well as the rest of the world try and run a higher level of inflation in order to escape that debt trap. So what does that mean? If we move to the final slide, what does that mean in terms of portfolio construction? So we run a flexible income mandate, and we've run with a philosophy of diversified alpha, where we're looking for, I think I've said this line 100 times to everyone, we look for the broadest possible range of fixed income assets and strategies, and we're trying to allocate the portfolio and allocate the risk to different types of fixed income assets and strategies. We're not wedded to, to any specific, whether it's credit or money market, etc. We want to allocate where we can find the best return versus risk. And I think that diversification mindset is even more important given the level of uncertainty, the level of volatility that's going to materialize over the next few years. I think the range of outcomes is dramatically wider than what it used to be. So we've got allocations to cash, floating rate notes, bonds, inflation-linked bonds, preference shares, local convertible bonds, local property, offshore money market, offshore convertible bonds, and offshore bonds. And our job has always been to diversify, and going forward it's going to be even more of an emphasis on diversification and trying to balance the risk given the potential range of outcomes out there. And what we've done to date is, in the recent times, is shift up, for example, the level of inflation-linked bonds that we've held in the portfolio. Even though in the near term the inflation carry is going to be quite low, we think structurally a portfolio like this needs a higher allocation to inflation-linked bonds, and also begin to tick up the level of convertible bonds, be it domestically and offshore. And now that we've seen some issues in terms of the credit market and credit spreads widening, we're seeing a few more opportunities to add some credit exposure, where in the last few years we've been very conservative when spreads were very narrow. So we constantly look at the potential return versus the potential risk and focus on diversification, and that's going to be more important going forward. But I think the portfolio is now well placed, even though the base return, I mean, we cannot escape the fact that we are in a low return environment and the repo rate is at record low levels. This portfolio in the last couple of years might have in some years delivered 9, even 10%. I'll be honest with you, it's extremely difficult to anticipate that type of return over the next year, over the next few years. But it's not our philosophy to chase return without understanding the level of risk we're taking. It's a return versus risk. So we can deliver a cash plus 2 to 3% return, control the risk, and diversify as much as possible. I think we're going to do a good job for investors going forward. So that's my story. Diversification has always been the philosophy, and I think it's more important than ever. Thank you.
Richard, thank you so much. One quick question. Could you perhaps just give a very brief comment a little bit about March, I guess, when we saw this massive spike in the yields in South Africa, etc., and just how you guys sort of rode through that, and how, I mean, was that very much a once in a decade or two event type of thing? So just talk through, as a fund manager, managing the fund through that March spike in yield.
Yeah, so I think if you look at that movement in the bond yield in March, I mean, as a percentage terms, I think I've sent the chart out to your team. I don't have it in the slide pack, but in terms of it move in percentage terms, we hadn't seen a move like that since the Asian crisis of 2007, when yields were actually a lot higher. Even, the taper tantrum of 2013, Nenegate, the move that we saw in March to the 10-year yield moving from about 8.80 to 13.5% at its peak. I mean, that is as dramatic a move as we'd ever seen. And unfortunately, even when we had a relatively conservative, we felt a conservative position in bonds, 10% allocation, that we took quite a bit of pain on that position. We also found that spreads moved wider, and we were very careful and made sure that we were marking our portfolio at accurate levels. We wanted to make sure that we, being fair to current as well as new investors. And because of that, we did have, the biggest drawdown that we've seen. However, in terms of what we saw, the risk premium and how elevated those risk premiums were on bonds, we actually took the opportunity to add a little bit of bonds to around 2% of bonds at around the 13% level, which means that when the recovery came, we did benefit from that. So we weren't maybe as aggressive as one would have liked, given the rally you've seen, which I think has surprised. I mean, the rally, I think, the recovery has been as surprising as the sell-off. But, you know, we have to balance risk and return. And I presented South Africa's fiscal position and how precarious that is. We are under no illusion that South Africa is in a very difficult position in terms of the level of debt. And the structural allocation to bonds, if you told me even 3 years ago that bond yields, we were going to be able to buy 10-year bonds at 12% plus yield, I would have said in the flexible income fund, let's go. We would, just what I'm knowing now, 12% bond yield and 4% inflation, I tell you, we would be at 25-30% in SAGBs. Unfortunately, we could only get up to 12 or 13 because we do not believe that that an allocation to bonds above the 15% level, given the risks and the downside risks out there, is valid. So we have to be very careful about over allocating, given the tail risks that are there in different asset classes. And as I said before, we focus on diversification, and that SAGB asset class, we are going to have an allocation, but the maximum is definitely, you can't have a maximum allocation when a country has a debt to GDP of 25% and a country has a debt to GDP of 90%. You can't have the same allocation out there. So our maximums is going to be lower, but it's going to be with a bit more flexibility and a focus on diversification.
Great, Rashad. No, thank you. And I think, yeah, you highlight there the trade-offs, and certainly, I guess, as you said, the balancing the act and decisions that, yeah, active managers need to be making. So, Rashad, thank you very much for your insights and time. And we're going to move on now to the next presenter. So I'd like to just introduce the next presenter is Murray Winkler, co-founder of Laurium Capital in 2008. And Murray was former CEO and head of research at Deutsche Bank before starting Laurium Capital. Murray is the manager of the Laurium Equity Fund, which is a domestic general equity fund that we do hold also across several of our funds that we manage as in terms of the Net Group multi-manager. And we've been invested with Laurium for just about a year or so now. But before I hand over to Murray, I'm actually going to hand over to Rob Johnson, who's head of best of breed investments at Net Group Investments, who has got some exciting news that he would like to announce for the first time publicly today. So, Rob, I'm going to hand over to you, and I know you'll hand over to Murray afterwards.
Thank you, Trevor, and good morning, everyone. Yes, as Trevor mentioned, I've managed to persuade him to give me a couple of minutes to let you all know about an announcement that we'll be making later today. I'm delighted to announce that a new best of breed partnership with Laurium Capital, and they will be managing our Net Group Investments Growth Fund for us from the 1st of July. As part of our best of breed philosophy and process, we've conducted an extensive search across a vast universe of asset managers investing in SA equities. That includes those currently within the CISA equity sectors that many of you will be familiar with, but also outside of that, many that are less accessible to the individual investor. When we look to partner with best of breed managers, the factors that we covet highly when selecting new partners for our range of funds include independence and autonomy of the group, an alignment of interest or a high alignment of interest with end investors, focused range of strategies, firm stability, a robust and consistent investment philosophy and process, and a highly skilled and experienced investment team. Now, with that laid out, Laurium Capital is an independent boutique. It's owned and managed by current employees. It has successfully grown its assets under management to now in excess of 25 billion rand. So very strong stability there. The South African equity portfolio management is a core part of their business, and they have a strong track record with a stable and well-resourced team of investment professionals. The one thing I haven't mentioned, and the final thing that we seek, is an identifiable edge or a unique approach to investing in SA equities. Now, Laurium centre on fundamental company research and evaluation, but then they also combine this with a view on economic cycle or market trends, using a flexible and nimble approach to adjusting portfolio exposure. And in addition, at times, they're able to take advantage of short-term pricing anomalies that may not be available to all market participants. Now, Trevor's done a really good job of introducing Murray, so I won't talk much more about that, but Murray co-founded Laurium, as Trevor mentioned, in 2008 alongside Gavin Verg. He's a portfolio manager and a key member of their asset allocation committee. Murray today is going to answer the question, is now the right time to back the local SA market? So over to you, Murray.
Rob, thanks for that, and Trevor. Laurium's pretty excited to be part of the Nedbank Group. So the topic today, South Africa's equities are very unloved, I guess. If we look back over the last 5 years, our market is, the Aussie's up 2% in rands, 2.5% down in dollars. And if we compare that to cash, obviously has done very well. And we compare that to the S&P, which is up some 11% per annum, and the MSCI World Index, which is up about 7% per year for the last 5 years. If we go back and look over time, the last 15 years, just to put in perspective how SA has done, the red line is a relative line that you can see on the chart that shows how the S&P is done relative to South Africa, and that has beaten SA by 70% over that time period. This is all in dollars. If we strip out the US, what you see, the blue line there, is that the MSCI X the US, South Africa's index is in dollars matched the rest of the world. And that's what we're going to focus on going forward. We're clearly not in the A League like the S&P, but the rest of the world, if we look at Europe, Japan, Asia, EM markets, we've actually haven't been too bad over time. So if we go forward to the next slide, to have a look, what do you actually get? Why have we managed to match the rest of the world X the US? And one of the things we forget is South Africa is one of the most diversified indices globally. On the left-hand side, we have the all-share index. And you can see that only 32% of the, only 24% of the performance or the exposure of the all-share index is linked to domestic South Africa. The rest of it is diversified. We have EM, a lot of that's really coming from Naspers and Process, a lot of DM. And then if you move on to the cap SWIX, which obviously a lot of the institutions use, we can see that South Africa there represents more. It's more diversified index, but that's 37%. So basically, when you buy the index, you're getting DM, you're getting EM, and you're getting literally probably on average around a third of SA Inc., which doesn't look too good at the moment. So let's move on to the following slide and have a look at because in the long run, earnings really drive markets. I mean, as Warren Buffett says, in the long run, the market is a weighing machine. It measures the earnings over time. And if we look over the last 15 years, the red line shows the earnings in dollars of the South African index. And you can see we haven't gone up much in dollars. We are, I guess, up some 25, 30%. Maybe it's not too bad over 15 years. But if we look at the blue line again, which is the MSCI X, the US, you can see how closely our earnings correlate because of our the diversification, how closely we correlate the rest of the world. So it's been fairly similar over time. We can move on to the next slide then, just to have a look at the relative ratings of South Africa. Well, maybe we first look at going forward on earnings. This chart shows 3 years projected earnings for the next 3 years. For South Africa, the red line, and that line right now, projections, consensus numbers are that we grow at about 5% compound per annum in dollars going forward the next 3 years, which it sounds pretty optimistic in our views. We think that will be probably quite a bit less than that. We still need some further revisions downwards. And the blue line shows the rest of the world ex the US, which is projected to grow at about 12%, also probably too optimistic on earnings. But what you can see from the red line, we were 2 years ago projected to grow about 20% in dollar earnings for the next 3 years, and that has collapsed. So the 3-year outlook has collapsed quite significantly to where we are today, and we think probably you could be closer to more realistically around the 0 level. So if we can move on to the next slide then. Let's have a look at the actual, on the left-hand side of that chart, you can see the absolute level of the multiples. So the all-share index, our index is trading on a 12-month forward multiple at the moment of 13 times. And then if you look, the equi less the US is about 13. And historically, you can see that we've traded around similar type of levels where we're trading at the moment. On the right-hand side, we compare the relative rating of ourselves against the MSCI equi, ex the US. And if you look over the last 15 years, we have traded generally at about an 8 to 10% premium to the rest of equi ex US. And we've fallen down now because obviously the bleak outlook for SA Inc. We're down now to about a 15% discount relative to the index. So that's a substantial derating. Now, we think that derating is probably more than it should be, notwithstanding the outlook we see in South Africa. So if we can move on to the next slide then. Now, one of the most important drivers for EM and in fact for non-US is the US dollar. So it's probably not so easy to see all the lines without pointing to it, but basically the black line on the right-hand side represents the dollar, the weighted average of the US real effective exchange rate of the dollar. And it's moved around over time and basically has been, I guess the 15-year period has strengthened by some 15% or so. But I think most notably, if you look at the dollar, the black line, from about mid-2014, the US dollar has been unbelievably strong. And it is appreciated relative to other currencies by about 20%. Now, what tends to happen, a strong dollar tends to hold back the dollar earnings of South Africa. And you can see how when the dollar tends to weaken, the dollar earnings of South Africa do quite well, and vice versa. So our dollar earnings have been under quite a bit of pressure. Now, there's a lot of talk of where do we go the dollar from going forward. We've seen it just literally in the last couple of weeks that the dollar's moved against the euro from 1.08 to already 1.13. That's a 5% move, and we can see how strongly our market has performed in that environment, and how the States has underperformed as well. So we think there's a case to be made that we could be entering over the next few years a period where the dollar is relatively weak or not so strong, which would be quite decent for dollar earnings, which applies to Europe and particularly for South Africa as well. So that could be quite a decent tailwind. And if that is the case, we will see resources should do quite well, a weakening dollar. We probably could get a bit of inflation in the States, and SA Inc. will probably also be a bit of a beneficiary of that. So if we move on to the next slide. I guess we've got to look at quite closely the South African market. So as Rashid said, we think we're going to be 10% GDP negative this year. We think a budget deficit around 15%. Our debt to GDP by the budget next year, we're probably at the 85% level and continuing to rise towards 100%. Our big problem is our cost of funding, which is at 10% versus the US, which is less than 1%. So we have a major problem financially going forward in South Africa, which the markets obviously are anticipating, but it's going to be pretty tough. The chart we show over here is over the last 7 years is a 1-year forward multiple for our own calculated domestic PE index. So we've got banks, insurers, retailers, diversified industrials and properties. And the forward multiple for the SA market the last 7 years has averaged around 12.5 times. You can see where we got to during the crisis at the bottom. That multiple was as low as 7 times, and it's bounced back now to around 10 as earnings have been revised downwards. We still think there'll be further revisions. We think consensus is too optimistic on numbers, but we do think that the market has really overreacted on valuations in a couple of sectors that look pretty attractive. We were very worried property as a whole, but I mean, a couple of stocks look pretty attractive, particularly Growth Points looks very undervalued there. Internationally, not SA, but Hammerson as well is one. And then if we look in the banks in particular, we think the banks look, ABSA Nedbank trading on 0.6 times price to book and 0.7 price to books. We don't think that they're going to need to come to the market to raise capital. There's a big margin of safety, and we think the banks look extremely attractive as well. So domestic SA, there's some decent areas. Retail, we're pretty concerned about. We think there's going to be a lot of capital raises coming from retail, and we have very little retail. For the domestic sector as a whole, in the portfolio we run, we are underweight that sector, but we do find that there's some pretty attractive stocks that one can actually own in that sector. On to the next slide then. Okay, so this is the last slide, and to finish off and saying, if you buy SA Inc., and we use sort of the Swix benchmark, Cap Swix is our benchmark, and I've sort of broken it down into a few sectors and say, if you buy that index today, what are you going to get and what is the outlook going forward? So firstly, if we look, Naspers Process is 16% of that index. So that's just the bench. Now, I guess that's fortunate for South Africa, because if you look at Naspers over the last 5 years, that has gone up 13% in US dollar terms, compound per year. So we are very fortunate to have it a big part of our index. It is a bit outsized. Going forward, Tencent, if you look at the core business, trades at about a 24 multiple, and it's growing sort of probably between 15 to 20% in dollars going forward. And we think it looks a very good long run business. If you buy Naspers, you're buying Naspers alone, you get 150% of Tencent because it's trading at such a deep discount. And Process is about 120. So they are trading at very deep discounts. Discount to some of the parts for Naspers currently is about 45%. So you're buying a good business long term, and then you're able to get in at a very deep discount. And Process not as deep a discount, but still very attractive. So we think long term that's going to do, but if we look out the next sort of 3 to 5 years, that should do very well. Global Consumer is another bucket. And in there, you're getting British American Tobacco, Reinet, which on valuations of 8 multiples and 7% dividend yield for BAT, notwithstanding poor ESG, looks pretty attractive. You're getting AB InBev in there, and you're getting Richemont, which Richemont's going to struggle, but on valuations now, it probably looks okay. Metals and mining is 20%. So in total, or 19%. Diversified miners, your Anglos, Bulletins, they on 10% free cash flow yields, less than 1 times net debt to EBITDA. And with the recovery in economic growth into the next 18 months, we think they will continue to do a sector that'll probably do quite well. And you've got some platinum thrown in there. And gold, long term, we do not like gold. We don't like the shares, but I think that it is maybe from a diversification point of view, I guess you're getting some gold in there. If inflation in the States comes through, the dollar weakens, gold will probably go quite a lot higher, the physical metal anyway. And then I guess the bucket of domestic SA, which we talked about, so that we are underweight that sector in our funds. We're probably running about 25% exposure. Quite a lot of banks in that bucket. Quite a bit of growth points, and one or two industrials that we really like in their transaction capital particularly. So that's a sector we think could probably do okay. And then the other rand hedge is really a lot of the international counters, the 91 asset managers, Quilter, Mondis, and broadly those are going to move very much in line, I guess, with the rest of the international businesses. So when you buy this business, when we say it's the time to buy SA, I think that the States on a relative basis, if the dollar weakens, EM probably is going to do, if we look out over the next few years, quite well. We're not only getting SA Inc., we're getting sort of a diversified portfolio, and we think that we should see some decent performance. Is it time now? All I can say is if I look relative to the US and relative to the MSCI index, since mid-April, South Africa index in dollars is already up 12% relative to those indices. So maybe it's already started. But anyway, looking forward, we think it doesn't look too bad. Over to you, Trevor.
Thank you. Thank you very much for that. I think you really covered everything that I was hoping and looking for, and I'm also just aware of our time. So we're going to leave it at that. Thank you very much. And I'm going to move over to our next presenter. Also just Murray, to wish you and Loriam good luck as well going forward with the Net Group Growth Fund, and I'm sure you will hopefully bring investors a success story going forward. So our next presenter is Carl Leinberger, Chief Investment Officer at Coronation Asset Managers. Carl's been with Coro and well over 20 years investment experience, and of course takes overall responsibility for the investment process and ultimately investment performance at Coronation as a house. In terms of Net Group multi-manager, we have holdings in quite a wide range of Coronation funds, some of the multi-asset funds, and we've actually been a holder of the Coronation Top 20 Equity Fund for over 15 years or so, since it was a very small fund. I've specifically asked Carl to just talk a little bit about Coronation's house view, how they're seeing the world at the moment, and also specifically, I guess, from a multi-asset perspective, their view on valuations across the various asset classes domestically and globally. So, Carl, I'll hand over to you.
Good morning, everyone. I think I'll make the point first up that this crisis has for me felt very much like the financial crisis, in that I think it has strongly demonstrated the importance of active asset allocation. If I look at Coronation's products, I look at our equity funds, they were through pure luck very well positioned for COVID and have performed very well through the year. If I look at our multi-asset class funds, they did not go they were not well positioned coming into the epidemic at all, being overweight equity and property. But if I look at performance against benchmarks and against peers, I think performance has very much been on the fairway, and we've delivered very close to benchmark performance through this year. And the only reason for that is the value that's being delivered from active asset allocation. We aggressively cut exposure to equities early in January and February. And then we materially increased equity exposure in late March and early April. We did a big rand hedge in our balanced funds on the currency, 18.20 rand. So I think these actions for me, and the financial crisis was very much like this, point to the value of active asset allocation. You know, there's often been a lot of criticism at multi-asset class funds that managers sit at long-term strategic allocations, you know, come what may, and that certainly isn't the case for ourselves. We will actively make asset allocation calls on your behalf. And And I do strongly want to make the point that we aren't through this crisis. I think that there are many challenges to come, and we expect to make meaningful changes to our asset allocation in the months and quarters ahead, as we proceed through what is certainly unprecedented times for all of us. Just to take you through our views on the major asset classes, I'm going to start offshore. If I start with bonds, we have been very negative on sovereign developed market bonds for many years, and that remains much the case today. We think it represents returnless risk. We are very concerned about unprecedented levels of indebtedness we've seen for sovereigns around the world. We are concerned that there is a risk of inflation in the years ahead as a consequence of unprecedented printing of money and a slow reversal of globalization. The only global bonds that we hold in our multi-asset class funds were credit bonds that we bought in the crisis in March, April, that have re-rated quite strongly, most of which we still hold, but could well sell if the re-rating continues. If we look at global equities, just to remind you, we were very negative on global equities in 2019, not because we saw coming what has happened, but purely on valuation. We used the COVID crisis to go from underweight to a meaningful overweight position. We're currently just under 28% in global equities in our balanced funds. We are reasonably optimistic and sanguine about the economic outlook for most of the world's developed market nations. We think that you're seeing a lot of pent-up demand. We've got low oil prices, and we've got the benefit that comes from unprecedented stimulus, both monetary and fiscal. Of course, developed nations are vulnerable to second waves of infection, but we do think we're through the worst of it. We do think that social distancing is the right way to go for across the globe, instead of what has been very damaging lockdowns. But yeah, we're not naive. We think that the only real off-ramp out of this COVID nightmare for the world is either going to be a vaccine or herd immunity. We think herd immunity is less likely because of lockdowns, because we haven't gone that route. And therefore, we think a vaccine is the way out. And that, all the experts are saying, is at least a year away, if not longer. We are negative on emerging markets outside of Asia. And that's because we think that they're so poorly positioned for the COVID pandemic. Most people in emerging markets live in densely populated living conditions. These are countries that lack the ability to do effective testing, tracing, quarantining. These are countries with limited social safety nets. Households and corporates live month to month. Governments lack the financial wherewithal to bail society and the private sector out. But I do strongly want to make the point this does not apply to Asia, which I think as a region has handled the COVID pandemic best, and that is where the bulk of our EM funds exposure is at the moment. I got a question on whether there's a bit of exuberance, irrational exuberance in global equity markets. Yes, we have been surprised at how strongly they've rallied out of the crisis, but I think that's always in the nature of markets. The market climbs a wall of worries. It may well be overbought today. It may well retrace significantly in the months ahead. But I think the message from me to you is that the last few months have been a fantastic case study in the dangers of trying to time markets too carefully. It feels just like the financial crisis to me. Markets rallied in the first few weeks of March in 2009, and it was when everyone least expected it, before there were any meaningful green shoots in economic activity. Once again, markets have rallied when we all least expected it, and our philosophy when we allocate capital and do asset allocation is that it is pricing of assets, not the timing of our expectations of market behavior, that must inform portfolio positioning. I think that equities were very cheap in March, April, and the right thing to have done would have been to buy, regardless of how tough the outlook looked for the months ahead. And we still think that long-term value lies in equities. We don't think it's in cash. We don't think it's in bonds. This is where the long-term value lies. And I would caution against excessive attempts to try and time the market, even if it does feel to all of us like global equities have probably rallied a little too hard. Just moving on to the SA market. Local bonds, we've held our bond weightings. We're currently about 15% in our balanced funds. I want to make the point that was made a little earlier, but I'll probably make it a little more strongly. We are very concerned about the risk of a debt trap in South Africa. We are very nervous. We see several years of double-digit budget deficits. We see government debt to GDP for South Africa that gets close to 100% in the next few years. We are very concerned that South Africa loses its fiscal discipline. We think that fiscal discipline was lost in the Jacob Zuma years. We think it was regained over the last 2 years, and we think there's a great risk that it's lost again. There's a massive ideological fight within the ANC at the moment as to whether or not they should use COVID to transform the South African economy. For many, there is an ambition of having a larger state, a more intrusive state, and we think that if that is ultimately pursued, it would be incredibly negative for the economy and for our markets. We've done a lot of modeling on government levels of indebtedness, and I want to strongly make the point that unless very hard political decisions are made to deliver austerity and to rein in debt levels in the next 3 years, then the opportunity will be lost. If hard decisions are not taken in the next few years, then I think we'll find ourselves on the wrong side of the power of compounding, and there won't be much that can be done to save the situation. So we are nervous holders of South African government bonds. We're watching the situation very closely, and if we don't get comfort that hard political decisions are going to make, we would actually be comfortable to sell out, even though they're yielding double-digit levels. We did use the crisis to build a small position in inflation-linked bonds. We haven't owned ILBs probably for 5 or 6 or 7 years. They're very unpopular at the moment, given the deflationary effects of COVID. But we do think that what they deliver in terms of diversification and risk means that a place in a balanced fund for ILBs makes sense for us. So moving on to SA equity, we are very negative on the SA economy. We think that the COVID crisis has been very poorly handled by our government. We think that the challenges of testing, tracing and quarantining have been very poorly handled. We think we've had one of the most draconian lockdowns in the world, which has made little sense given how blunt an instrument it is. We think that there's massive fallout for our households and our small businesses. And we're very concerned about the long-term economic damage done in this period. It might well be right to take the brave call today and buy beaten up domestic stocks. And those close followers of Coronation will know that there have been many times in the last 25 years when we've taken the contrarian view and bought assets out of favor where the short-term outlook is poor because we felt the long-term value was there. We just aren't there at the moment on domestic stocks. Our concerns about the long-term outlook are just too great. And we decided in the crisis to use our clients' risk budget to rather buy global assets that had been global stocks listed on our market that had been hammered in the crisis. We're big buyers of stocks like Anglo, ABI, Bidcorp, all stocks which in the eye of the storm, in the eye of the COVID storm. And that's where we've used our clients' risk budget. The domestic stocks that we do own are only the highest quality businesses in South Africa. So we have a list of South Africa's 12 best businesses. 3 or 4 years ago, we could only afford to own 3 of those 12 stocks. We currently own 9 of those stocks in our portfolio. So the domestic exposure is only the very highest quality businesses where we're comfortable that those businesses will retain their earnings power through this. I was just asked a few questions on the currency. We do think that the currency became oversold in the crisis. As much as we're negative on the long-term outlook for South Africa and as much as the rand is our country's release valve, we do think the currency got oversold, and we actually think there's a decent chance that we come close to running a current account surplus this year. There's very little import of capital equipment. There's very little import of consumer goods, given how weak the economy is, and exporters are back manufacturing, but mainly mining. And we think, therefore, that there's a chance that we run a current account surplus. We think that the rand is oversold. In our balanced funds, we have a 5% hedge. So 5% of our offshore exposure is being hedged. We did that at 18 Rand 20 to the dollar. And I think if we get close to 16 Rand to the dollar, that will become a source of heated debate inside Coro as to whether or not we take that off. But currently, we feel quite comfortable having hedged a meaningful portion of our offshore exposure. So that's really it. It's a just under 15-minute summary, 11-minute summary of our key views on asset allocation. I don't know if you have any questions for me, Trevor.
Yeah, Carl, perhaps just one quick one. Can you just give a brief comment on South African listed property and how you guys, I mean, again, we know that took a massive hit. Having said that, it's up 25% just in the last 8 days or so. But just Coro's sort of medium-term view on South African listed property as an asset class.
Yeah, so property is without a doubt one of the more interesting sectors. It's right in the eye of the storm in that there's been huge short-term disruption to the rental streams for all of these businesses. COVID will precipitate disruption in so many industries, and physical property is a great example of that. Work from home is going to transform the office environments of the future. Businesses will need less space. It's accelerated the adoption of online commerce for retail. So retailers around the world, and in South Africa, no exception, will need less space. Property companies are highly leveraged. They were highly leveraged coming into this, and the crisis has further aggravated that situation. In addition to that, there's a lot of poor quality earnings in the property sector. We don't have, we have a lot of concerns about the quality of earnings and the accounting within the property sector. So my big message in property is that for sure there's some value there. For sure there are good quality assets with good management teams that will come through this crisis. Those stocks look very depressed and money will be made. But this is a sector where you really need good stock pickers, where you need lots of disciplined research. There's a lot of poor practice that crept into the sector in the bull market that is being exposed at the moment. So I'd be very hesitant to endorse a sort of sectoral positive view on property. I think you don't want to buy the benchmark. I think disciplined stock picking is really important. And the thing about property is the tough economy is going to be fully evident in a retailer's results this year. In a property company, because rentals mature in a staggered fashion over the next 5 or 6 years, the full impact of the economy is still to come. So a lot of work is required in the research process to fully understand just what is going to happen to the earnings base in the next few years. How much is this going to reset by? So I think caution is warranted, but I think that if you're prepared to take the long view, and if you've got good research, there are stock picking opportunities in the sector.
Perfect. Thanks for that, Carl, and thank you very much for sitting in and your comments. Appreciate it a lot.
No problem. Thanks for your support.
Thank you. So we are going to move on to our next presenter, and that is Andy Headley from Veritas. I think very well known to many of South African clients of Nedgroup Investments. So Andy is a founder, fund manager and head of equity research at Veritas Asset Management in London, where he's been since 2003. He's the manager of the Nedgroup Global Equity Fund, which Veritas has been managing since 2012. We, again, in terms of the multi-manager, are a big supporter of Veritas. We've held the Veritas Global Equity Fund in both our offshore dollar and sterling denominated funds, as well as through the Nedgroup feeder fund on the local side, where it's one of our core global equity holdings. And we've had it, for 7-8 years or so in the portfolio. So I've specifically asked Andy just to, again, of course, give Veritas's view on global equities. I've sort of positioned to him that we've seen post the 23rd of March, a 40% uptick in the world index and global equities. and does he see that as being too much too quickly? So I'll hand over to you, Andy, for the next 15 minutes.
Thank you, Trevor, and good morning to everybody from a very wet UK today. So the summer is not shaping up so well over here. So Trevor's asked me basically, have global equities gone up too quickly? So clearly, just taking a timeline, we've had a huge exogenous global event in COVID-19. The treatment prescribed by pretty much all of the major economies and policymakers has been an enforced lockdown. So that's obviously leading to a recession. So we know we're having a recession in pretty much every economy around the world. So a global recession, and consequently, as investors became to understand that in sort of mid to late March, we saw markets fall substantially due to that uncertainty. And the uncertainties at the time, of course, were huge. So we had COVID-19 uncertainties. What was the mortality rate? What was the infection fatality rate? How did it hit different demographics? We obviously then had the impact on earnings and revenues. We then had the question to try and understand what the duration was of COVID-19, so the impact on earnings and revenues. How long is it going to last? Which for a long time was unknowable, and perhaps even still today is largely unknowable. And then obviously finally we had uncertainty in terms of what the government and policy response would be. So there was a huge amount of uncertainty, and markets, as we all know, hate uncertainty. So markets did fall substantially those last 2 weeks of March, and in our view, there was an opportunity for investors. That week of kind of the 23rd of March, markets fell substantially, and the sell-off was pretty indiscriminate at that point. We actually created two lists to look to invest in. One was a high quality list, and one was a COVID affected list. So the high quality list, things like MasterCard and those kind of businesses. The COVID affected list, things like booking.com. So obviously travel and entertainment related. And actually what we found was that pretty much everything fell about the same. MasterCard was down from $350 to $200 at its lowest. So it fell, whatever that is, 40 odd percent, nearly 50%. Booking was down maybe 50% to 60%. So yeah, there was a huge opportunity for investors at that point. The recovery since then has obviously been very sharp and much faster than would typically be suggested by a normal market discounting horizon. So that's typically 12 months out or so, 12 to 18 months. And so we've seen this extremely sharp recovery. And the reasons for this are again, not too surprising. The COVID-19 data is available to some degree. And so we kind of know what the infection fatality rate is. We've obviously seen some treatment paradigms come about. So there's a number of treatments out there, remdesivir probably being the best one, which alleviate the symptoms. So should prevent more people going into the severe stage of the disease. And there's obviously some work being done on vaccines around the world, and so people have become more positive on vaccines and the likelihood of a mass vaccination program, which I will come back to because we're a little bit more pessimistic on the time frame for that. So we obviously know a bit more about COVID-19 and therefore its likely duration. We also had policy. So we've seen a policy response around the world. There has been around a 10 to 15 trillion, depending on how you count the numbers, policy response. So to put that in perspective, I mean, pre the COVID pandemic, global GDP is something like $85 trillion. So the policy response to this, 10 to 15 trillion dollars in the context of an $85 trillion global economy. So it's about the loss of the global GDP that we'll see, if not a bit more, has been the response. I think thirdly, in terms of the equity market, and it's been touched on already, bond yields today are so low that I think in general equities have become the asset class of choice in this recovery. And then that's led to the kind of self-fulfilling cycle that once the recovery has started, that there's then been this fear of missing out. And so we have seen this very, very rapid V-shaped recovery in equity markets. And in some ways, the recovery was typical, it's just very compressed. So the sequencing of the recovery was very typical. What we saw first was the recovery in the kind of idiosyncratic growth names that originally led the market before. So the Amazons, the Apples, the Facebooks, the Googles, all of those software names like Intuit, Adobe, they led the recovery. And then what we've seen in the last sort of 3 weeks, particularly the last 2 weeks, has been the value recovery sectors have been performing extremely well. And that's typical in equity market recovery. So what we've seen has been investors are pricing in, we believe, this V-shaped recovery. If we look at 2021 earnings, so I think most people expect that 2020 earnings have been written off, really. If we look out to 2021 earnings expectations, consensus expectations, they are now somewhere between 10 and 15% below the expectations that existed on the 19th of February. So that was before there were any worries over coronavirus, COVID-19. And 2021, the expectation now is that there's only a 10 to 15% decline in earnings by then. In fact, if we look at earnings in the last couple of weeks, those earnings expectations have begun to rise for 2021, which shows that investors are really pricing in this idea that economic recovery is going to come back very quickly. And I think some of the data that's come through has played into this. So what we've seen has been US non-farm payrolls. We're up 2.5 million for May. And that's played into these kind of expectations of investors that actually what we're seeing is a V-shaped economic recovery. In Veritas's view, though, we think the risks are now asymmetric. Equity markets are at or near their highs. Obviously, depends on what you look at, but Nasdaq is there. S&P is not far off. Clearly, we are going to have a recession, or we're in a recession. Valuations, therefore, have become higher than they were earlier in the year. And what we don't know is the duration of this recession. We're still unclear as to how this is going to pan out. Our view is that the recovery from here is likely to take a lot longer than people believe at the moment. So we don't believe in this V-shaped recovery. We think it's going to be drawn out. And part of that is to do with the vaccine. So a vaccine is unlikely to be widely distributed before the end of 2021, in our view. And the reason for that is not so much developing the vaccine and producing the vaccine, which we think can probably be done by the end of this year or the first quarter of 2021. The issue is much more safety. So all of the authorizing bodies, so particularly say the FDA in the US, will be very reluctant to adopt a mass vaccination program of a vaccine until it's been proven safe in a large phase 3 trial. The regulators got caught out, I think, in about 2010 with a vaccination for dengue fever called Dengvaxia, which was by Sanofi. And it led to an increase in fatality rate for people who contracted dengue fever, particularly children. And so the regulators are well aware of the issues with vaccines. And so I think that before we get a mass vaccination program that extends to billions of people, we are going to have to see a substantial amount of safety data, and that just takes time. So it's likely the safety data will prevent max vaccination until the end of 2021. And until that time, we're likely to have some sort of social distancing and other policies in place that will impede an economic recovery to some degree. So we think it's a slightly slower recovery, and yet markets, we have this chasm now because markets have recovered. And as I've said before, it's a lot of it is driven by policy. So we've seen a lot of bond buying by the governments and monetary policies. They've supported the high yield debt market. It's obviously led to lower yields, neutralizing risk in the financial system, and it will help preserve employment. But in one way, the expense of this is it's underwriting equity valuations. And so policy is aimed to bridge the gap. And we think now that the valuations are basically pricing in a lot. If we look across our universe of companies that we analyze, we're now looking at a mid-single digit IRR. So across the 240 companies or 250 companies that we analyze, we think that we're going to deliver somewhere between 4 and 6% across those companies for the next 5 years, which is a pretty low IRR given the context that we're in. So we are concerned about this. So the answer to the question is yes, we think the market has travelled too far too fast. We do believe, however, there are pockets of value, Trevor. So we think there are some pockets of value in the travel and entertainment related side where those things have not recovered as well. So we are looking at a number of names, and we own a number of names in this area where we've increased. What we've done in the portfolio so far, just very briefly to finish off, is we came into 2020 with over 12% in cash. We felt valuations were high. We'd sold a number of things like Microsoft, a few other names towards the end of last year. We basically invested all of that during the big declines of the crisis. So we've invested in all of them are in very high quality companies. As I said, we had these two lists of high quality companies and COVID affected companies. And we were prepared to buy either depending on valuations. But what we found was the high quality companies pretty much fell as much as the COVID-19 affected list. So we've been buying a lot of very high quality companies, and we now have cash. Cash went down to about 1% in the portfolio. As we've seen markets recover and these names doing well, we've actually just started trimming some of the more economically sensitive names that their performance has been fabulous, but they, for example, advertising exposed names such as Facebook and Google, where the performance has been exceptional given the risks that face them and the advertising risks. And so we're just taking a little bit out of those positions as we speak. But that's probably enough of a summary to give you a bit of time to ask some questions, Trevor.
Yeah, Andy, thanks for that. That's great. You sort of stole a little bit of the one question here. So just in terms of your holdings within the portfolio, can you just speak a little bit to how many stocks you currently have in the portfolio? And I think you've answered the cash portion, which you've now brought it pretty much down to fully invested. Have you maintained sort of quite a focused portfolio, or have you found that you've needed to diversify a bit more?
Yeah, it's a good question. So in principle, we always retain a pretty concentrated portfolio. So we're typically somewhere between 25 and 35 positions. As of today, we're at 29 positions. But we have added a number of positions during the decline. So we during that week of whatever it was, about the 23rd of March, we bought MasterCard, we bought Becton Dickinson, which is a US healthcare name. We bought Abbott Labs, Diversified Healthcare. We bought Alibaba, and we bought Cochlear, which there's a very interesting story attached to, which at some point I'll describe to you. But Cochlear is Australian, the market leader in cochlear implants. And so we bought 5 new positions during the declines, and we sold one just prior to the major declines, which was a healthcare name called Dentsply Sirona, which is very obviously dental related. So they do equipment and consumables in the dental arena. And we just felt that actually if our view on COVID-19 was broadly right, that it would be a long time before dentists saw a lot of work coming back to normal. And so we felt that the equipment manufacturers for dental would be significantly affected. So we sold one position and invested in 5 new positions to take us up to 29 positions in total. But cash, on the cash point, we came into the year with just between 12 and 13% in cash. We got down to 1%. We're now at just sub 3%. So we're slowly increasing cash, and we'll continue to slowly increase cash if markets continue on this huge bull run. I mean, obviously we've got the Fed statement this afternoon. There's been some talk about the Fed moving towards yield curve control. I suspect they won't announce yield curve control, but if they even intimate that that's what they're looking at in the future, then equity markets could continue to rise substantially. So it's very at the moment we feel like we're in a market that is hugely policy driven, and so it does depend a bit on policymakers. But if we continue to see substantial rallies from here, we will be reducing into this.
Great, Andy, thank you so much for that, and for dialing in. We appreciate it, and yeah, stay warm. It's also cold winter, rainy day here in Cape Town as well.
Yeah, you expect it in winter though.
Yeah, we do. Well, you expect it in summer as well. Great, thanks very much, Andy. All right, I am going to now introduce our next presenter from Ladles of Love, Danny Diliberto. So Danny was actually born in Zimbabwe originally and came over to South Africa as a teenager. And he was born into an Italian family, which meant he went into the restaurant business. And that naturally he then found his way into starting the Ladles of Love in 2014, originally as a soup kitchen feeding just 70 meals once a week. So Ned Group Investments as a business a month or two ago, we were during the mid-crisis of Corona trying to discuss what we as a business could do to make a difference during the coronavirus. And we did a bit of looking around and came across Ladles of Love and basically found this to be the perfect route for us to get involved in, as it was something local around Cape Town, where we could noticeably see that we could sort of make a difference to what's happening on the ground. So through the generosity of the management team at Ned Group and staff, we sort of all donated and have helped Ladles now with the funding of some of the 3 soup kitchens that they're rolling out in terms of their longer term plan to the feeding problem and hunger in Cape Town, etc. So I've just asked Danny, who was the founder of Ladles of Love, to really just discuss with us today and tell us the story of Ladles and also give us really a first-hand experience of really what's happening out there in the townships, etc., with the hunger and the desperation during Corona and I guess our winter now that we're facing, and today being a perfect example. So Danny, I hand over to you. You're on mute, I think, Danny. You must just unmute.
Morning. Sorry. Morning, everyone. Thanks, Trevor, for your kind introduction. Yeah, as Trevor mentioned, I'm Danny Diliberto. I'm founder of Ladles of Love. It was founded back in 2014 on the basis of a Sanskrit word, seva, spelled S-E-V-A, meaning giving of yourself, wanting nothing in return. It was on a course that I was doing. We had to do seva that day, and it was an interaction that I had with a homeless guy. How this interaction brought back a moment of dignity and quietness, and a bowl of food really brought some relief to him. That it just all clicked, and being in the restaurant business, it just all clicked into place. That starting a soup kitchen was really the best way forward. So yes, we started with 70 meals a week, 70 to 100 meals a week, and over 5 years we grew into 4 soup kitchens. We started working with 4 different schools. We worked with 4 other organizations, their own feeding programs, and we were doing around 15,000 meals a month, which was about 3,500 to 4,000 meals a week. And then Cyril Ramaphosa, as we all know, instituted a lockdown, and it was a very interesting moment for me, because I just had the sudden urge that I knew I had to get out there and do more. I didn't know what it was. I didn't know how I was going to do it. I just knew that Ladles of Love had to get out and serve more people. So I worked with the city to arrange that we could continue our operation as an essential provider to the vulnerable. So that was all organized, and so we began our operation. I started off with the homeless community within the CBD, working out, because our soup kitchens were all closed down due to lockdown. I started working with the shelters and trying to find ways that we could get the food out to the homeless people through shelters and through other organizations, through churches and community halls, etc. And so we worked on that. that took us about a week or so. We worked out our plan, and I had breakfast and lunch sorted for the homeless. And then I knew that was just not enough, that I had to get out to the communities, because I knew that there was going to be so much unemployment and people hungry, people not being able to go to work, people not getting paid. So I started figuring out what was the best way to get food into the community in a safe way that would be used for eating to as many people, and not to be resold or kept for personal use or whatever it was. So I was working on food parcels, but it was proving bulky and very expensive. And then I started deciding that I needed to connect with nonprofits that already, or community leaders, or people, or church halls that were serving soup kitchens, that had started serving soup kitchens due to the COVID lockdown. And I started connecting with these people. So I started working with the people that I knew that we were working with, and I started asking for referrals and who else has soup kitchens, etc. And so we started connecting with the non-profit network out into the communities, out in Mitchell's Plain, out into the locations like Delft, Khayelitsha, etc. And I'm not sure, it was very strange when COVID initially hit our shores. Everything started slowing down. Donations started slowing down. I mean, life started slowing down, and I was really concerned. I thought this was either going to make or break Ladles of Love. And it was just very strange that as I was out there trying to serve the community, just more and more people started joining our community, and all of a sudden donations started trickling in, and then started really flowing in, and it was almost as if like dam walls broke, and this flood of kindness started coming our way. We were blessed with volunteers, and we were blessed with donations coming in, and so with more and more donations coming in, we started taking more and more non-profits to help with their soup kitchens, and so it grew. And also probably about week 2 or week 3, about week 2 of lockdown, we decided that we needed to find maybe get sandwiches out, get people to make sandwiches, and what started as an innocent little sandwich making drive at home with some of our volunteers just all of a sudden exploded into the sandwich making machine that just started growing and growing and growing. And within weeks, we were literally imploding on our growth. It just became, our premises, our space became too small. Our sandwich drive was growing exponentially. Everything was growing exponentially, and we were really beginning to hit a wall. And the more people that we were helping, the more people that were coming for help. So the situation is, people began to connect with us that were needing help and just coming to us for help, and it was just becoming all too overwhelming. So I connected with a friend of mine who we've worked before. She helped us with our Mandela Day initiative last year, which was very successful. She's got an events company, and she came and visited our organization the one day, and she just saw the chaos, trucks coming, trucks going, volunteers tripping over each other, sandwiches arriving. It was non-profits arriving. It was just crazy what was going on. And she looked at me and she says, "Danny, I need to get you a bigger place, and we need to get your sandwich drive onto a CRM." And so that journey began. And thank God she came in at that time, because we really would have imploded. We just weren't coping with what was going on. Social media was going crazy. People were doing their own things. People were using our name to try and raise money. It just became chaotic. And so Alison managed to arrange the CTICC for us, the convention center. And within a week, we were moving out of our little premises into a 1,500 square meter hall, which you can see behind me, some of it behind me. And so we began to continue growing our operations. And we just continued to grow. So to give you an idea, year, we've gone from doing around 1.2 tons of produce a week. We're now doing over 50 tons a week on produce that's going through our doors. A total of 171,000 meals have been sent since lockdown, hot meals that we've served, and over 900,000 sandwiches have been sent out into the community that have been served into the community. We've calculated around a total of 147 tons of food that we sent out, and in total we've probably served around 1.6 million meals. The only reason that we've been able to do this is because of all the kindness that we have experienced out there. It's been phenomenal. Volunteers coming on board. Our sandwich drive, we literally have the entire peninsula making sandwiches for us. And we've all connected it into the CRM that runs the system beautifully. So we collect, I mean, on Monday, we collected over 30,000 sandwiches just on Monday. I mean, so it's just phenomenal. Like I get blown away by watching this. For me, it's miraculous on a daily basis. What is happening? The need is continuing. It's actually getting more difficult. I mean, the other day we went out to film a community that we connected with, and I've heard this from a number of our non-profits that there's a lot of animals, dogs and cats in the townships, and what they do is they put little bowls around the streets with a little bit of dog food, so that the animals can go and eat whenever they want. And what started to happen is that the children were starting to eat out of these bowls, so that they had to take the bowls away because that's how desperate the situation is getting. That is definitely the saddest story of all the stories that we get to hear. So we are continually as hard as we can. We've had to put a hold on how many beneficiaries we're helping, because we're currently on around 110 beneficiaries that we are assisting, and of that's our primary beneficiaries, and our secondary beneficiaries is around 260. So of the 110, they also assist other soup kitchens. One of our organization collects 5 tons of produce a week from us, who then distributes it to another 60 soup kitchens in the Kraaifontein area, for example. So we're working with around 360 beneficiaries around the Western Cape. The donations continue to come in. We are working hard. The challenge with expanding at this pace is how do you minimize your expenses and continue to spend the majority of the money on the cause, and that's becoming quite a big challenge, because when you grow to this size, you can't rely on just volunteers. You need to have a core team behind you that are driving this initiative. So we have a team behind us. I'd say we've got about 20 people that are our core team now, that are really the brains of the organization, and we run our marketing, we run our non-profit vetting, our contact with our non-profits. We're trying to create a database of non-profits that still need help out there, and we've actually had to stop that button because we're just not coping with the amount of non-profits asking for help. So
Danny, sorry, Trevor
yes.
here. Sorry to interrupt you. We've got
No
like
problem.
3-4 minutes with you. Sure. Can you just maybe end off, which you were touching on, just like post-COVID, I guess, the plan, which, as you know, we've sort of become a bit involved in, which is your sort of rolling out of soup kitchens in the communities that will be there post-COVID.
Yes. So one of the things we're trying to do is trying to empower some of the soup kitchens. We want to roll out. So what we've done is we've created a starter kitchen of like a soup kitchen. I'll probably move my computer because I've got one right there. So for those of you that are watching the screen, I don't know if you can see it, but that's pretty much a kitchen over there. That is a starter kitchen that could easily cook 500 to 1,000 meals a day. So that kitchen costs around 18,000 Rand, and we want to award those to some of our non-profits that we've been working with on a long-term base, well, since the beginning of COVID, ones that need these kitchens. And the idea going forward is that we also want to connect chefs with these kitchens. So once a week or once every 2 weeks, the chefs will go and work with these guys and teach them better skills, teach them more skills. So hopefully this will empower them, and maybe they can turn these into little businesses as well that can generate an income for them, that can keep their soup kitchens going. So that is one of the plans going forward. But yeah, it's been an amazing journey. The kindness has been unbelievable. The one thing I am finding quite challenging is planning, because I'm finding COVID so fluid, and the moments, our time is so fluid that it's proving very challenging to plan your way forward. So you put ideas out there and then you see which way you can go. So we've got lots of ideas that we're working on, and our goal is to keep sustaining this. That
Right.
will become the journey of Ladles, to continue sustaining non-profits and helping non-profits with their soup kitchens and getting food, because this is going to be a long-term thing. This is not going away anytime soon.
Danny, thank you so much. That is an amazing story. And as you said, I mean, what really struck me was, as we've said, you know, you went from 2,000 meals a week to 250,000 meals in the space of a month virtually. And as you said, just organizationally managing that is not an easy task. So well done, and keep up the amazing work that you're doing.
Thank you very much.
Thanks for your time, and thanks for dialing in.
Cool. Thank you.
All right, so thanks everybody. So I am just going to end off with about 10 minutes or so of some insights from myself, and then we will draw this webinar to a close. So Nabila, you'll put my slides up there. So basically, I just thought it would be worthwhile to end off with a couple of reflections from myself and my multi-manager team of managing, I guess, the funds as well through the last 3 months or so of the coronavirus pandemic. And some of my comments, I guess, will be tie in quite nicely with comments that the various fund managers have given. So if we go to the first slide, I've sort of broken up my comments into two broad sections. First of all, just some investment insights, and I'm really going to be very quick on this. But again, these are insights that were reinforced through this coronavirus crisis and from previous lessons as well, going back to the global financial crisis in 2008, 9, 10. So first of all, I think the one is liquidity. And again, as a multi-manager, fund manager, what we had learned from the global financial crisis is investing into funds that are liquid, to avoid, if you remember in 2009 or so, in many of the alternative hedge fund spaces, etc., you got into liquidity crunch, there were side pockets, and one couldn't get your money out. So we've always ensured to go into liquid investments with daily dealing in order to be able to react when required. Then also diversification. It has been touched upon by Rashad, by Carl, and across all of our portfolios, we focus on diversification, both across asset classes as well as domestic and global. Having said that, and we saw it happen again during the March market collapse, is that even when you are diversified, very often asset class correlations align during times of extreme market stress. And we saw in March, equities fell about 15%, bonds was down 9%, and listed property was down about 37%. So all three of the major asset classes actually were down. They didn't really provide that sort of non-correlation, but certainly versus holding all your eggs in one basket, even in that stage, it did benefit. Then fear and greed talks to a little bit about your time of trying to time markets. Again, we see it time and time again, and in the, even sometimes, you know, and wealth managers, fear the people, and down 20%, down 30%, you can't capital losses, and there is sort of need to want to move yourself into just to protect potential future. Few slides on it, just that really very often that is the worst timing and worst to be doing manage one's movements. If anything, actually in times of again, that is, you need to be increasing your risk exposures. Market bull runs, and when markets are up really strong, jumping on the bandwagon, it's actually be time to be taking off some of the risk. So our feeling and lessons is that you do need to also take into account always the macroeconomic. So it's not just something or something. You look at the macroeconomic environment, see what it's telling, because otherwise you can't in value are cheap reasons, and there is a chance that if trends have changed or the economy is structured, that recover. Seen just over the last few years, I mean, there is more industry on some governance. This whole corona and the market and sort of locked economy, how some of these aspects been highlighted and become more and more relevant. And of course, even the issues of climate, seen heat maps and pictures taken from satellite pictures, etc., with the whole pollution and no airplane travel, etc., has materially reduced some of pollutants in the environment, and all that climate, and I think this lockdown has highlighted what manufacturing, etc., has the impact on the environment. Again, this has been highlighted. We've seen, I mean, the perfect example is even just today with this webinar. Originally, we were meant to be having our multi-manager day in Joburg, face-to-face with all our clients. Now we're doing it via Microsoft Teams on a webinar type basis, which actually is, I think, works very well and efficiently. So it's a perfect example of potentially new trends, new technology, and we've seen it even in stock prices with companies like Zoom, etc. I saw an interesting stat that Zoom, the market cap of Zoom, was about $50 billion, which was larger than the 7 largest US airlines market cap all put together, that came to about $40 billion. So that's just a massive change in the marketplace. If we just go to the next slide as well, here, this is talking really a bit to, I guess, the more emotional, softer side of things. And this is a bit of a personal check-in, I guess, from myself and my team. And I think we've certainly, and also talks to a bit Danny's presentation of the extreme hunger and poverty that people are facing across the world, not only in Cape Town and in South Africa. And certainly for us and myself, who's been blessed to still have a job and continue to have a job during this crisis and get paid a salary and be able to pay one's bills, certainly I think is something that one shouldn't take for granted. And I think it's vital, and the Ladles for Love story, I think, reinforces it, is the massive amount of empathy of people and the love around to help people that are struggling and in hardship. And of course, just all of these things, you know, whenever I was watching CNN, was watching Sky, Boris Johnson one day was sitting in his office feeling pretty okay, and 3 days later he was in ICU in the UK hospital. It did sort of bring into importance of just how lucky it is to have one's health and not take things like that for granted. Another interesting insight that, you know, we felt was hindsight is a perfect science. I mean, we see this we see it all the time in the investment world. People often asking us as fund managers, why didn't you do this and why did you not do that? And generally, these are questions asked after the fact and not before the fact. And it's really tough and difficult being fund managers. You know, of course, we're having to make asset allocation and investment calls all the time without perfect knowledge or foresight of what the future holds. And I think this is highlighted as well in terms of the global leadership across governments and countries during the last 4 or 5 months. And we see some leaders have really stood up to the plate really well, other countries perhaps not as well, and time will tell which strategies were better or not. But it's very easy, I think, often to point fingers at leadership and say, why have they made certain decisions? But one has to remember, I think, that, you know, COVID and coronavirus is something that we're all learning, and one doesn't have the answers all the time perfectly. All right, I'll just end off with a few, I think, some interesting slides if we go over. And this really just talks to, first of all, the global markets. And this is just showing you that global markets, as up till the 8th of June, so we're talking 2 days ago, at the lowest point which global markets hit was the 23rd of March. And at that point, it was a fall of 32% in US dollars. As of 2 days ago, markets had recovered. They were up 43% in US dollar terms and just 2% below the year-to-date starting figure. So it's been an amazingly quick and strong recovery. And I think it just talks to, as some of the managers have spoken already about, is just you need to stick to your investment cause, investment plan, and this fear when markets were falling, if you had switched out into cash, you would have lost out materially on the strong gains over the last 2.5 months. And if we look at the next slide, which just looks at the South African equity market, it's very much the same story. So here, the South African equity market was down 34% at the lowest point on the 19th of March. And as of 2 days ago, it's up 44% and just 4% off the high point that we started the year out at. So again, strong recovery, and really one needed to stick to your guns. And if anything, as has been alluded to during the fall of the market, as things from a valuation perspective were becoming cheaper, it was the time to be buying and not selling. And if one had followed a solid, rigid investment process of buying things as they became cheaper, so you would have benefited now by increased risk exposure during the market rebound. If we go to the next slide, this one is just showing you this real returns over a 3, 5 and 10-year period. And let's just focus on the longer term, which is the 10-year period, which is the green bars. And this is just looking at the major asset classes: South African equities, property, bonds and cash, and then global equities, property, bonds and cash. And really long term, what one would expect from asset classes is roughly a 6 or 7% real return for equities, about also 5 or 6% real return for property, about 2% for fixed income, 1% for cash. Now, if we look at the South African asset classes over the last 10 years, the green bars on the first 4 one on the left, you can see global or domestic equities has given you only about 3% real. Property in the last 10 years, 2% negative, bonds about 2% and cash slightly positive. So extremely low real returns for the last 10 years on all South African asset classes. The offshore asset classes are a bit better. They are at around 12 and 10% there. This is in rands. And the vast majority of that, about 8% of that return, is due to rand weakness. But so holding offshore holdings in one's portfolio over the last 10 years would have added to portfolio performance. If we go to the next slide, what we're seeing over here, again, I'm going to not going to detail. This just shows you market falls over the last 100 years or so. And really what we see on this is the green negative falls are where the market has fallen by 20% or more. So let's call it a bear market of a fall of 20% or more over the last 100 years. So you'll be looking at the Great Depression, we're looking at the global financial crisis, the tech bubble, etc. The light green above the line shows you the amount of time that it took for the markets to recover to the previous high point that they were before the fall of the 20%. And then the blue sort of color is the continued bull market in that recovery period. So one can just see that consistently over the last 100 years, when we have had bear markets, they've been followed by periods of recovery. Recovery happens often quite quickly, and then we have quite long periods of quite strong positive returns. So again, we shouldn't panic too much in the last, market drawdown of March, and history really repeated itself as we've seen on the earlier slides with strong market recoveries. Going to the next slide, what we're showing you here is just, again, a perfect example. So what we've shown you here are the 4 major unit trust categories. So we've got your low equity, medium equity and high equity Reg 28 prudential categories, and then the general equity category. And we're just showing you the one is the 1 month return for the month as at the 24th of March. So for that period, 24th Feb, 24th of March, which was really when the markets collapsed, your average low equity fund was down 12%, medium equity down 17%, 20%, high equity, your general equity funds was down 27%. For the immediate next month, the month 24th of March to the 24th of April is the green bar on the right. So you'll see low equities was up 10, 13, 16 and 20%. So and immediately followed by an extremely strong month. And then the grey bar is as at 2 days or so ago. So from the 24th of March till 2 days ago, and you can see there the average funds are up 14, 19, 23 and 32%. So again, it's really vital to not panic, to stick to your investment guns. And we can see here how very quickly markets can turn, and hence if you had moved in cash, you would have lost out materially, which affects your long-term performance. To the next slide, what we're showing you here is just the last 20 years of real returns, but broken up in over the last 2 decades. So it's really interesting. If we look, first of all, the blue bars is the decade from 2000 to 2010. So it's your real returns. And if you look there, you can see how strong South African asset classes were. So South African equities in that decade, 2000 to 2010, you achieved 11% real on domestic equities, 20% real on property, 6% on bonds, and 3% on cash. However, if we look at the decade 2010 to 2020, it's a very differing story. So there we've seen, which was a little bit came through on that earlier slide, it's offshore that's provided the real returns of 12%, 10% for the last decade, and South African equities has given you very low real returns. So it's been a tale of two very differing decades. And if we look at the next slide, where we really put these two things together and we look at what have the real returns been across asset classes over the last 20 years, so for this century so far, quite interesting. And we do see that the risk asset classes over this 20-year period have still delivered their sort of expected real returns. So we see South African equities has given you 8% real, and property also 8.2% real, bonds 4%, and cash 2%. So that's the real return for South African asset classes over the last 20 years. And then on the offshore side, global properties given you 7%, global equity 4%, and bonds 4%. Again, this is in rand terms. So when you look at the rand currency movements in that, the last decade, the rand has averaged weakness of about 8% per annum. And in the first decade, 2000 to 2010, the rand actually strengthened on average by 2% per annum over that decade. To the next slide, just to end off, this is just looking actually at a little bit of a stock level, and it's really just interesting. What we're just showing you here are some stocks that have been some of the big winners and losers year to date. And it really, I think, just is to make the point of, again, how important stock picking is. And of course, that's the value of where some of the equity fund managers come in. So you'll see this is the value of 100 Rand invested from the 1st of January as at the 29th of May. So 10 or so days ago, the real winners, I mean, there you'll see the all share index is at 88 or so. So it was down 12% still at that date from the 1st of January, but your real winners giving you returns of somewhere between 20 to 40% were your gold stocks, which makes sense, you know, a safe haven during times of risk off sentiment, as well as our big technology and rand hedge stocks like Naspers, Prosus, British American Tobacco. Those were the stocks that did well, and certainly during the corona crisis, it was those stocks that helped equity funds stay up quite nicely and not fall too much. Having said that, on the domestic side, you can see some of the South African, the banks took a big knock, and some of the retailers. So we've put Nedbank in there, for example, was down 50%. Famous Brands down 56%, Massmart down 60%, and some of the Sasol down 70%, etc. So there were the more South African orientated stocks, retail stocks, financial stocks, much more cyclical stocks took a massive hit. Then we've seen, just again to make the point how quickly things move, if we go to the last slide, it just shows you the same stocks, but as at the 8th of June. So it's just 9 days later. And if we look at, for example, Nedbank down now only 38%, so the banking stocks were up about 15% or so over the last 8 or 9 days. Sasol is up well, you'll see there you're down 40% instead of 70%. So Sasol's up 30% just in the last 10 days or so. And where it's been a much more risk-on environment, and some of these stocks at the top, your gold stocks, have fallen back, and your sort of blue chip rand hedge stocks have roughly stayed flat also. So again, it's just highlighting, I think, how stock picking is so important, and how various sectors of the economy can really move sharply and quickly depending on whether you're on a risk-off, risk-on type of environment. So that's all I really wanted to just say. I think it really highlights some of the key lessons from a fund management perspective, from a wealth management perspective, and hopefully again helps you guys to manage your clients and their emotions and expectations during times of market crisis. So that really brings us to an end for today. Hopefully everybody found that useful, helpful. I'd like to thank all of our fund managers that have participated, thank the team, technology, etc. And I'd like to wish everybody a great rest of the day. And just to finally remind people that on Friday, David McWilliams, based in Ireland, he has previously spoken at some Ned Group events, an economist, a journalist, a writer, a broadcaster, very entertaining, very smart guy. He will be doing a presentation, so I encourage you guys to all dial in for that. So thank you very much, everybody. Have a great rest of the day and look forward to the next Multi-Manager Insights in a few months' time. Cheerio.